All right, today we're tackling a real head-scratcher, Viasat. Their latest earnings report looked, well, pretty bad on paper. A clear miss, but then the stock just exploded. So what in the world did the market see that the rest of us missed in the headlines? Let's dig in and figure this out.
Okay, so first let's just get the bad news out of the way. These are the numbers that hit the wires. On profit, or loss, Viasat posted a negative $23 per share. Wall Street was only looking for a loss of about 82 cents. So that's a big miss. And revenue? Same story. They brought in $1.12 billion, just a hair under the $1.13 billion estimate. I mean, look, by any normal measure, you see these numbers, you think, yikes, that's a rough quarter.
But then this happened. The very next day, the stock just launches up almost 20%. So you have to ask, right, what happened? How does a company miss on both the top and bottom line and get rewarded like that? Clearly, the big money saw something in the fine print, something that made those headline misses totally irrelevant. And that is the real story we're going to unpack.
Okay, so to really get the market's logic here, we've got to peel back the onion. You can't just look at the consolidated numbers. You have to understand that Viasat, right now, is basically a tale of two completely different businesses.
And boom, here's that split in black and white. You've got one side of the house, their defense and advanced tech segment, let's just call it DAT, growing at a blistering 20% year over year. This is the good stuff, right? High margin, in-demand technology. But then you've got the other, bigger part of the business, communication services, and that actually shrank by 6%. So what did the market do? It completely ignored the shrinking legacy business and put all its focus on that powerful growth engine.
But you know what? That incredible growth in the DAT segment, that was only piece number one of the puzzle. The real reason Wall Street got so excited had almost nothing to do with revenue. Nope. It was all about cash, a massive, strategic pivot toward financial discipline and just plain generating cash.
First up, just look at this number. Operating cash flow. It surged by more than 60% from last year. We're talking $219 million here. And why does this matter so much? Because this number cuts through all the accounting nonsense. It's the pure cash the actual business is spitting out. It's a huge sign of underlying health.
And here's the other half of that equation. At the same time cash was surging in, they slammed the brakes on cash going out. They slashed their capital expenditures, their CapEx, by a massive 40%. Now that is a signal. It tells investors the company is officially done with that super heavy spending phase for its new satellites. They're moving from spending mode to harvesting mode. It's all about cashing in on those investments now.
So you see how this all connects, right? The market's bull case is actually pretty simple when you lay it out. You've got strong growth in the best part of the business, you've got a flood of cash coming in from operations, and you've got them aggressively cutting spending. Put it all together, and what do you get? A crystal clear path to fixing the balance sheet, deleveraging, and becoming a free cash flow machine.
All right, so that's the story the numbers are telling. Now let's see what management had to say. Because, let me tell you, their commentary on the call didn't just support this idea, it was the entire theme. They basically shouted from the rooftops exactly what investors were hoping to hear.
I mean, it doesn't get much more direct than this, does it? Management came right out and said their top priorities are repairing the balance sheet and generating cash to pay down debt. This wasn't some little footnote. This was the headline from them. And that gave the market a ton of confidence that this new focus on discipline isn't just a one-quarter thing. It's the new strategy, period.
And they backed it up with their guidance with real numbers. They said they're slashing full-year CapEx by around $200 million. They guided for adjusted EBITDA, that's a key profitability metric, to actually grow. And here's the big one. They specifically called out the second half of fiscal 26 as when they'll hit a free cash flow inflection point. You see? Every single data point they gave hammered home the story of a new, leaner, meaner Viasat.
So, with this huge strategic shift now out in the open, what does this all mean for the next earnings call? Well, that's where we come in. We've crunched the numbers, and here's our take on what to expect.
Okay, for their next report, Q4, we're calling for revenue to be pretty much in line with the consensus. That same story, strong DAT growth making up for weakness elsewhere, that's probably going to continue. But here's where we differ. We're actually looking for a slight beat on adjusted EBITDA. We think all that cost discipline is really going to start flowing through to the bottom line. And finally, on CapEx, we expect them to keep the spending tight, probably coming in even lower than the street expects. They're not taking their foot off the gas when it comes to preserving cash.
So when you put it all together, the clear pivot to cash flow, the powerhouse defense business, and a credible plan to fix the balance sheet, we are officially assigning Viasat an outperform rating.
The market's finally waking up to this turnaround story, but we think there's still plenty of room to run as long as they keep executing.
All right, before we wrap up, let's have a little fun with a more advanced idea. Something you might hear pitched on a trading floor. It's a way to play this Viasat turnaround story while trying to insulate yourself from the whims of the overall market.
It's called a pair trade. The concept is pretty straightforward. You go long Viasat stock because you believe in their specific story, but at the same time, you go short the XLC, which is just an ETF that tracks the whole communications sector. The logic here is to neutralize the sector. So if the whole industry goes up or down, it doesn't matter as much. You're making a pure bet that Viasat will outperform its peers, regardless of what the tide is doing.
So when you boil it all down, the big takeaway from Viasat's quarter is this. Forget the headline miss. The real story is the cash. The company has a new, compelling game plan centered on financial discipline. But of course there's a risk, and the ultimate question now is all about execution. Can they really stick to this lean new strategy while still fighting off intense competition and, getting those last few satellites successfully into orbit? That's what we'll be watching.
And of course, a quick reminder, this is not financial advice.